From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
We made it to Friday in the wildest week that ever was when it comes to tariff policy and resulting financial market action. Welcome to Balance of Power on Bloomberg TV and radio. I'm Kailey, Leinz, live in Washington with David Gura filling in for Joe Matthew as we round out this week in Washington with more escalation in the trade spat between the U.S. and China. China responding to the now 145% tariff rate on Chinese imports the U.S. has imposed with a 125% levy of its own. And yet they suggest, David, it's not going to go up from here because it would be economically meaningless to do so.
Yeah, the Chinese Ministry of Commerce characterizing this as a joke from the White House, but indicating that if this continues, they will hold their own. They will retaliate. They'll fight this to the end, I think, as they put it. So the uncertainty remains here in Washington that's existed since the president put that pause in place just a couple of days ago. The White House indicating they're waiting for a phone call between President Trump and President Xi. So far, no indication that that's in the offing.
And yet it seems that equity markets are at least finding some reason to have some risk appetite into the weekend. We're just off the highs of the session on the major benchmarks. And interesting to see the action in treasuries today, which is really the bond market where a lot of the so-called queasiness the president was talking about has been centered. Right now, we're only up 4 basis points on the 10-year yield. We've kind of come right back down from the highs we hit earlier in the session.
Very much the focus over the course of this week. Of course, it's what precipitated that pause, as we understand it, from the president, him looking at the bond market going into the morning of that announcement, seeing the queasiness that you described, seeing the yippiness that I think he said he saw as well when he was outside the White House. And of course, we've charted these auctions over the course of the week, the 3-year, the 10-year, and the 30-year. Charlie Pellet up in New York has been following all of this as well and has an eye on the markets for us this afternoon. Charlie, give us an update if you will.
All right, we are higher across the board, David Gura. Do want to begin with the weekly numbers because we are on track for a weekly gain on the S&P of 5.2%. To put that in context, the previous week, the S&P was down 9.1%. So here's where we stand right now. As you both mentioned, very close to session highs on the S&P, now up 57. That is a gain of 1.1%. We've got the Dow up 386, now up by 1%. NASDAQ up 212 for the NASDAQ Composite Index, up by 1.3%. The Russell 2000 Index of small cap shares now higher by 0.3%. The 10-year 4.46% with the 2-year that's currently yielding 3.91%. Spot gold up $52 the ounce, up 1.6%. 32.28 the ounce on gold. West Texas Intermediate crude 61.10 a barrel, up 1.7%. And Bitcoin ripping higher now by 3.6%. Bitcoin 82,757. Bank earnings fast and furious. Things kicked off this morning. JP Morgan Chase up 3.2%. Wells Fargo, though, heading the other direction after earnings, down 1.6%. Morgan Stanley up 0.6%. And BlackRock up by 2.5%. So again, recapping, the Dow, the S&P, and NASDAQ are all moving higher. Right now, the S&P is up by 1.3%. Balance of Power continues now. Back we go to Washington. Once again, your hosts, David Gura and Kailey Leinz.
Charlie, thank you very much for that update. You mentioned those bank earnings, and I was listening to what we heard from the CEOs of those companies, Charlie Scharf in particular, and Jamie Dimon of JP Morgan. And there was a question from Mike Mayo, the longtime bank analyst, to Jamie Dimon about whether he's worried that JP Morgan would be caught in the crosshairs of this trade war. And Jamie Dimon said, yes, he thinks that's likely, but the bank is prepared for that if it does happen. And I think that kind of encapsulates the rhetoric that we've heard from Jamie Dimon over the course of this week, sounding the alarm about the long-term prospects of the situation that we're in here, but kind of reaffirming confidence in the institution that he leads in light of all of that. But uncertainty not just in the global economy, in the financial sector as well, as they kind of wait and see, as we all are, for what happens next, Kailey.
Yeah, certainly we've seen a lot of that uncertainty borne out this week. We also have seen it borne out in consumer sentiment. We've been tracking the UMich consumer sentiment readings incredibly closely, and remarkable to see it dropping today to 50.8. Not only did that miss the average estimate, it's the lowest we've seen in some years, and inflation expectations ratcheting dramatically higher to the highest levels actually we've seen in decades really gives us some insight as to how all of this uncertainty around tariff policy is actually impacting the consumer engine of the U.S. economy. And that is where we begin with Mike McKee, who's, of course, Bloomberg's international economics and policy correspondent. So you put together the UMich data with the incredible oscillations we have seen in terms of policy and resulting market activity. this week, Mike, doesn't exactly paint the prettiest picture.
It does not. I got to turn on the button. The Chinese say the Trump policy is a joke, but Americans aren't laughing at this point. The expectations index for the economy down the road in about 6 months fell to 47.2. That suggests people think we're going to have a recession, and that is the lowest since 1980. So we are looking at some really bad numbers here for overall consumer sentiment. And according to Joanne Shu, she's the director of surveys at the University of Michigan, everything's down. People think that the odds of losing a job are much higher. The odds of finding a job are much lower. The odds of inflation are much higher, as you mentioned. And the outlook for business is terrible. The outlook for their own finances is terrible. There is a lot of fear among Americans out there. And the question is, do they follow through on that? You know, we saw a lot of buying ahead of tariffs, and people told the Michigan survey takers they were going to do that. Now, Joanne Shu says that people are saying it's probably too late. So does this mean they all stop spending and a recession becomes inevitable?
Mike, I want to ask you how you look at these data and you report on them. I don't expect you to defend them, but I can give you a taste of what I think the rhetoric's going to be like surrounding all of this. And we've heard it over the last few times this index has come out. Complaints that it's perhaps leans one way in a partisan fashion. More people on the Democratic side are surveyed than on the Republican side, et cetera, et cetera. How do you see this in kind of the panoply of data, yes, that we got this week? You can complement it with the hard data that we got on inflation, but even more broadly still, if I'm Jerome Powell in the Eccles building looking at that famous dashboard, how much credence, how much importance do I give these data generally and in this moment as we're sort of waiting to see what happens?
Well, it's kind of two different questions there. If you're the Fed, you look at the data and you ask the question, what are consumers going to do? And you look at the one-year inflation number up to 6.7% after yesterday's CPI at 2.8. You start to worry that inflation expectations might be becoming unmoored and that rising inflation expectations will lead us to more inflation. There's not much they can do about it at the moment. We've heard from a lot of Fed officials, including John Williams today, saying policy is tight enough to bring down inflation if we just leave it alone. But then you asked about the survey methodology itself, and I did put that question to Joanne Shu today, and she said she defended their work as historically accurate. If you go back and look throughout time, that basically you see the same results. And what they have found this month is that Democratic support for the president's policies or for the way the country's going has obviously fallen into a deep hole, and nobody's surprised by that. Where the president has really lost ground is with independents, and they are now forecasting a recession as well. Republicans, who were approving of all of this by about 99%, are now down to about 71%. So even Republicans are starting to feel bad about the direction of the economy. There's probably some statistical question you could raise about it, but and this is not a political poll that's going to result in anybody getting elected or not. But it does suggest that people are concerned no matter their political party.
Well, I wonder what else the Fed is looking at or will have caught its attention this week, Mike, specifically when it comes to the activity we've seen in the bond market. As we mentioned, and Charlie ran us through, we're off the session high on the 10-year yield. We're now only up 5 basis points at 447. But there was a point today where we were looking at the worst weekly sell-off move higher in yields going back to 2019, when problems in the repo market with the actual plumbing caused the Fed to intervene. Do we have a sense of how close we might be, or are we on the precipice of that kind of moment again?
No, it doesn't appear that way. We've talked to a lot of Fed officials, myself and the others on our economics team, over the last day or so. And basically what we're hearing is that they're monitoring this very closely. They're in touch with all kinds of people in the markets. And while the moves have been extreme, it's not because of a failure of market function. It's not that you can't trade. It's that people at this point are shunning U.S. assets, it appears. There's not as much worry as some might have you think about the basis trade unwinding. There's a feeling that people who had been long leverage have had time to deleverage, so it doesn't look like a hard stop coming. That could always change, of course, but as long as the market is functioning, the Fed is not going to worry about it, and that'll be the big question and the thing to follow. They do watch bid-ask spreads. If they blow out, you've got a real problem if nobody wants to trade. But if the market is functioning, Fed, as I've said before about the equity markets, doesn't care if you lose money.
I keep coming to this question of whether we're seeing decoupling in its beginning stage or where we are in that process. And I wanted to ask you, Mike, just about the kind of voracious appetite China has had for U.S. Treasuries over the last many years, and sort of what happens if that seizes up, if China begins to turn away from them or sell them. Just help us kind of play out what that would look like here in the global market.
Well, obviously, if China were to dump bonds, that would be a major problem and would cause major dislocations just because they own so many of them. But at the same time, if they started dumping bonds, they're going to lose a lot of money because, of course, the price will just collapse the more they put into the market. So there's a lot of skepticism that the Chinese would do this. Now, they can buy a lot less. The problem we have in tracking that is that what we're looking at is official government purchases or purchases through official channels. And that has flattened out, but Chinese state-owned banks and other state-owned enterprises have apparently been absorbing a lot of the U.S. securities that the central bank used to, and so they're still holding an awful lot, which is one reason they can keep their currency at about the same level. And so it's going to be hard to know unless they really go into the market. And that, of course, would destabilize everybody, but also them.
Well, I'm glad you mentioned Chinese currency because I want to focus on what's happening in the currency markets as well. Not trying to make you an FX analyst, Mike, but you would think that higher tariff rates, at least traditionally economic theory would tell you that might lead to a stronger dollar. And yet that is exactly the opposite of what we have seen this week. The dollar today weaker against everything in G10. And I wonder what we should make of that weakness and whether that is actually something that is likely to be persistent.
It's really hard to say. You're right. Theory would tell you that we'd get a stronger dollar out of tariffs. Now, the tariffs have only just come on, so we have to wait and see what the currency demand, the demand for dollars is to pay those. But if the U.S. stops trading with China, which at these tariff levels there would be virtually no trade, then there's no reason for the dollar to strengthen because the Chinese wouldn't need dollars. But if this continues, it could be that we're seeing people start to move away from U.S. assets. And when you need, what we have done is we buy stuff from other countries, send them our dollars, and those countries buy treasuries. Well, maybe they're going to buy German bunds instead, or French oats, something like that. So we could see that having an impact on the dollar as well. It's a little hard to tell how this is going to play out in the long run, but it's definitely not going by the book, and it is worrying some people. There's always the question about whether the U.S. is going to lose its reserve status. I don't think that's going to happen because there's really nobody who could pick it up. But we could certainly see a lot less dollar usage if countries really want to do that.
Michael McKee on this Friday afternoon. Mike, thank you very much. Mike McKee, of course, our chief international economics and policy correspondent here at Bloomberg News, kind of giving us the tour here, yes, of how the Fed is thinking through all of this, what we're seeing in the currency markets, in the bond markets as well, and giving us the latest sort of assessment of that sentiment survey from the University of Michigan that we got this morning. I want to turn now to Joe Lavorgna, who's a managing director and chief economist at SMBC Nikko Securities. He was former special assistant to the president, chief economist at the National Economic Council during President Trump's first term. Joe, great to have you with us. And I'd love to start this by asking you sort of how you see these next few months proceeding here. You've been in the room with the president as he's thought about trade, no doubt thought aloud about trade and sort of how he sees policy. What do you expect is going to happen here, aside from hopefully, I imagine the president thinking the phone call, the phone ringing? How does he approach these deals? What's he looking for in terms of just the mechanics of putting these deals together?
We had those reciprocal tariff announcements, as you know, April 2nd, and I was pretty confident that, we were going to at least have that in place until, it wasn't going to change until we got to the 9th. And then when the 9th, of course, struck and they were in place, shortly thereafter, the president announced there'd be delays. And I see that because the negotiation process had been done. So you need to come with these tariffs that were very high, very aggressive, and then in the process that was bringing people to the table. And now the negotiation has begun. To me, the maximal amount of uncertainty in some sense with tariffs was earlier this week before that announcement occurred. And now we could just go forward. And my guess is the president is going to make deals with various countries, and that will be to the U.S. advantage, and we're going to kind of clean up this uncertainty, and then we'll move on to the next thing, which will be the budget and what spending cuts, if any, and how they'll impact or help the economy. But I do think this tariff uncertainty will pass. I think the market has. I understand why the market's reacted the way it has. I don't expect it to continue. I do expect the volatility to subside as progress on trade negotiation moves forward.
But it's not just about the market activity, right, Joe? It's also about consumer and business activity, who, while they're waiting for clarity to see what the outcome is 90 days from now, they still have to make decisions with their own purchasing power now, decide what they're doing in terms of inventories, where they're sourcing the supply, what purchases they're making. How much damage realistically can be done, even if you think ultimately we end up at a better place at the end of the day, or at the end of this period, I should say. We still have the whole period to get through.
No, absolutely. And this uncertainty, even as it relates to tax policy and the budget, is also a factor. Right now, it's been a very relatively short period of time. If we're looking at the labor markets, the jobless claim numbers are low. If we're looking at the consumer spending side, the chain store numbers look pretty good. If in the next week or two, there is progress on the trade, I don't expect this uncertainty to really meaningfully have any long-lasting or appreciable effect on the economy. The economy is very resilient. It's very robust. It will come back. If we go 90 days or we're day 89 and there's been no progress made, yes, absolutely, that'll be a problem. But I don't expect that to be the case. I do think we're going to, my hunch and guess, gut tells me we're going to get some good news somewhat soon.
Joe, about the kind of inherent inflationariness of all of this, I'm curious sort of how you're looking at this. John Williams is speaking at the Puerto Rico Chamber of Commerce right now. He says that his expectation is that these tariffs are going to boost inflation this year to 3.5%, 4%. We've heard from the president's economic advisors during this term a sort of more greatly reduced sense of the inflationary impact this is going to have. What's yours? How do you marry your kind of forecast with what I just mentioned there, what we heard from President Williams of the New York Fed and the White House team today?
We've been of the view that energy prices will come down. That'll be a very powerful offset, especially to any what I think is still likely to be a modest impact from tariffs. So, for example, if you had a 10% across the board tariff, 60% on China, as the president had proposed on the campaign trail, that doesn't even lift in price level terms your CPI more than a point. And of course, it'd be offsets from the currency and offsets from the margins. But on the inflation side, the fact that oil is down at 60 is very encouraging. That might have been due to the administration pushing the Saudis in particular to increase oil production. That will provide an offset. So, I mean, the inflation outlook right now is still uncertain, it's still sticky. The Fed is, I think, looking too much in the rearview mirror on this stuff, because if you look at the markets right now, they're telling you, looking at break evens, there's no inflation problem. And that's also, I think, one of the reasons why the market is behaving, that risk assets have not behaved as well today, is they've listened to Fed commentary from President Williams and think that the Fed might be making a mistake by harping too much on the inflation side and less on the potential growth side, meaning the economy could be slowing. That's what more investors are worried about right now than inflation.
Well, have you changed your own expectation, Joe, for the kinds or the scale of Fed rate cuts we could see this year, the number of them?
No, we've actually been pretty stable. I mean, we marked our growth down based on what will be the weak Q1. We've got GDP around 1.5%, and with most of that weakness concentrated in the first quarter. We did raise our inflation forecast a bit, but not massively. And we kept the Fed basically not cutting until the second half of the year, which is where we've been for a while. I don't think the Fed needs to cut in the short term. I don't think the Fed should cut in the short term. And therefore, we see no change. We've got two cuts, one 25 in September, another 25 in December.
I want to ask you about dollar weakness, and Kailey just a moment ago kind of running through a number of the pairs indicating we're seeing softness in the dollar today. And again, drawing on your experience during the first term, I wonder sort of what insight you can give us into the way in which the president looks at the strength of the dollar relative to other currencies. Of course, there's this conversation maybe swirling in the background still about this prospective Mar-a-Lago Accord getting folks to the table there. It seems like in this current environment with the lack of communication between the U.S. and China, that would be a difficult thing to pull off, to say the least. But what's your sense of the outlook here from Washington on global currencies, the way that this president is looking at the dollar today?
So in general, the trade weight, if you look at the Fed's real broad trade weighted dollar, it's close to a 40-year high. So this notion that the dollar is expensive, you see it in the Fed data. Investors tend to focus on the DXY, as you could pull up on your Bloomberg terminal, which is a very narrow nominal basket of currencies, and that's been a bit weaker. Over time, I could see the dollar perhaps softening a bit, but for good reasons. On things like the Mar-a-Lago Accord, I don't know if that's going to happen. I'm just not privy to those discussions. I think given the president's love of branding and marketing, it'd be hard for me to think that there isn't a Mar-a-Lago Accord at some point, but what it entails, I don't know. But just for a minute on the markets, right now we're clearly in a very sharp deleveraging period. And I wouldn't be surprised if some of this selling just naturally burns itself out, especially as we get more chatter that, hey, look, the administration with its trading partners is making some progress. And ultimately, my base case for the economy, because I'm still an optimist, is that there will be a deal reached with China as it's in both countries' best interest. And I think the Chinese will want to negotiate, and the president, having had some successes with other countries that will precede those actions, will basically push China to do so.
I want to ask you about the bond market as well, though, Joe, because obviously that is, we understand what caught the president's attention enough that he was actually inspired to do a little bit of a policy shift with this 90-day pause on reciprocal tariff rates. When you see the kind of activity we've seen in the bond market, the upward pressure we're seeing on the 10-year yields, is that something you attribute mostly to this back and forth over tariffs, or does that signal something else to you about whether or not U.S. Treasuries are seen as the kind of safety asset that they once were, considering the other kind of fiscal trajectory-oriented issues that the United States is still grappling with, knowing we have a debt ceiling fight potentially ahead of us, that we're going to be looking at a tax package that could increase the deficit if there's not enough spending cuts to offset it. How much is that factoring into what we've been seeing?
So there's a lot there to unpack, but on the 90-day, I don't know if I can remember everything, but on the 90 days,
just explain the bond market to us, Joe.
Okay, so I think so. On why did the administration make a very quick pivot? And to me, this is my own 2 cents. I'm just trying to figure this out, piece the puzzle together. But Kevin Hassett was rumored to have set a 90-day extension on Friday. That was well before the bond market had sold off sharply. And coming in Monday morning, the bond market, the 10-year note was at 385, and then since had a big move after. I think once there was chatter among the various parties that there would be negotiations starting, my guess is the administration said there's no point at this point in not suspending for those countries that want to negotiate with us now. What are we gaining by waiting? Now, I don't think it was the bond market. I don't think it was necessarily the equity market. I think it was just a whole array of factors. What are we getting? What are we benefiting from? If we're having a conversation, let's try to provide some clarity by having that negotiation now. In terms of the budget, what I'm interested in seeing is, does the Senate parliamentarian, how does she attribute the scoring? Are we going to go with a current policy, or are we going to go to current law? Because those deficit numbers the CBO has, we could debate what the number will be, but the numbers they have on paper simply do not make any sense, because a policy that's been in place for over 7 years that has given us revenue share of GDP in line with its long-term average is not going to create by itself a shortage of revenue and larger deficits. What will be is if we have a recession, which I don't expect, and then what happens, of course, on the spending side. That's up for debate. I have no idea what happens on the spending side. I'm hoping we could find some common ground and make some cuts, but that we don't know, and we won't know anything until Congress comes back in 2 weeks following the Easter holiday.
All right, Joe Lavorgna, answering my multi-part question. We appreciate it,
Ably
as always.
doing
Former
so.
Special Assistant to the President and Chief Economist for the NEC in the first Trump White House, now Chief Economist for SMBC, Nikko, Securities America. Always great to have you here on Bloomberg TV and radio to help us make sense of the activity we have seen in financial markets this week across asset classes, just as Charlie Pellet does for us each and every day here on Balance of Power. We'll head to him now for a check on the markets in New York. Hey, Charlie.
Hi, thank you very much, Kailey. Leinz. We're looking at a lot of green on this Friday. We are on track for a winning week here with the S&P on the week up by 4.8%. To keep that in context, the previous week the S&P was down by about 9%. But here's where we stand now on this Friday. S&P up 58, gain of 1.1%, 53.26 where we stand now on the S&P. The Dow Jones Industrial Average up 378, up by 0.9%, while Nasdaq is up 181 points. That is a gain of 1.1%. The Nasdaq 100 index up 1%. The Russell 2000 index of small cap shares gaining now by 0.3%. The 10-year yield at 4.47% with a 2-year that's currently yielding 3.93%. Spot gold up $50 the ounce, 32.26, up 1.6%. And West Texas Intermediate crude up 1.7%, 61.07 for a barrel of WTI. Bitcoin surging 3.8% now at 82,900 on Bitcoin. Tesla has stopped taking orders in China for Model S sedans and Model X SUVs, both of which are imported from the U.S. after the countries raised tariffs on one another in an escalating trade war. Tesla shares today, on a day when the rest of the market is advancing, Tesla is down by 2.4%. And the retailer Five Below is asking vendors to turn away products waiting for shipment in China before they set off for the U.S. This according to a memo viewed by Bloomberg. Shares of Five Below, they are down now by 5.2%. So again, recapping, equities higher, the Dow, the S&P, NASDAQ solidly in the green, on track for a winning week, a 1% advance right now on the S&P 500 index. Balance of Power continues right now. Back we go to Washington. Once again, your hosts, Kailey, Leinz, and David Gura.
Charlie, thank you very much. David Gura here in for Joe Matthew, and I just want to do some market geography here, look at what's driving markets. Obviously, it's what's happening in Washington, the level of uncertainty that we've seen over the course of the week. Taking my geography lesson further, going up to New York and San Francisco, we had these big bank earnings. That's something that people are paying attention to. Folks also watching what's going on in Ann Arbor, Michigan, where the University of Michigan does its survey of consumer sentiment. We got a stark reading today. That sentiment, the lowest it's been, second lowest it's been in history. Inflation expectations haven't been this worrisome since the 1980s. Joanne Chu is the director of the surveys of consumers at the University of Michigan. She runs that survey. Here's what she had to say about its conclusions.
Consumers are in a very much a wait and see situation. They're really bracing for the other shoe to drop in terms of trade policy leading to eventual price hikes and higher inflation. So you have kind of these competing things of people are trying to beat future price increases.
So for more, we turn to our political panel as we consider what consumer sentiment means for political capital in Washington for the president and the party in power, which is the Republicans. Rick Davis is with us, Stone Court Capital partner and Republican strategist, half of our Bloomberg Politics contributors panel, the other being Jeannie Sheehan Zaino, our Democratic analyst and senior democracy fellow at the Center for the Study of the Presidency and Congress. For those of you who don't know, here on Bloomberg TV and radio, UMich sentiment is Rick Davis's favorite economic indicator. We know he has read this in its entirety today. And Rick, I do wonder what it's telling you about where the American electorate is and whether or not they're still feeling very aligned with the president's policy priorities.
Yeah, look, I mean, obviously, some of it depends upon the party that you identify with. Democrats are the most gloomy. Independents have been becoming more and more gloomy. But I think the real wake-up call for this report out of Ann Arbor is that Republicans are getting gloomy. Their focus on the future has dimmed significantly, that they believe that inflation will continue to get worse. And by larger and larger numbers. And so that's the part that this administration needs to be paying attention to. David Gura asked me earlier what's going to be like for these members to go back home and hold a town hall. And really, I mean, it's the Republican members we're talking about because they're going to get the brunt of the negativity that is present in this consumer sentiment index. I mean, these are the people who go to town halls, who call their members up and complain, and they're going to get very loud over the course of the next few months. And this report indicates a real slide for people of your own party if you're a Republican.
Rick, of course, this is sentiment data. It's based on anecdote, and I note here that survey was conducted between March 25th and April 8th, so before we had the pause that was put in place by the president. Since it's anecdotal, I'll turn to you, get your sense of how you're feeling about this. But do you think that it's likely to change now? Sentiment has improved because the pause has been put in place. I think that's what we're being told to believe here by this White House, that this pause kind of gives us some breathing room, gives the White House the latitude and time to broker some of these deals. The circumstances have notionally changed as a result. When you think about sentiment, how consumers and small businesses are looking at this moment, how much does that pause matter, I guess, is what I'm asking.
Yeah, I think the White House is trying to believe their own press. I mean, you've had a slide in consumer sentiment since December, right? I mean, it was at one of its peaks for the last 5 years on Election Day. And ever since then, there's been nothing but sort of trouble within consumer sentiment. It's down 30% since December. That is not something that gets then reversed by pausing what is expected to be additional tariffs being levied on these trading partners. So I think that unless there is a clear case being made by the White House for what positive things are going to occur to these consumers as a result of this policy, then they're going to be troubled by the chaotic nature of the policy making. And that's by definition, right? We have to go through 70, 80, 90 negotiations to come out with what is going to be the plan. And consumers are not going to be very patient about that.
Well, of course, the administration also is telling consumers they just need to be patient for a little while longer until Donald Trump's tax package can be passed. Genie tariffs are just one part of the economic picture that this White House is trying to paint. The other being, of course, his sweeping policy he'd like to see implemented, not just on extending his 2017 tax cuts, but implementing no tax on tips and Social Security and overtime, maybe deducting car interest from your taxes as well to offset the pain of auto tariffs. Are we going to find that patience is not that long in duration, that people aren't willing to wait to see that at year end or whenever that kicks in 2026? They need answers from the White House now?
I think so. You know, the danger of this consumer sentiment, it's very much like when I went to college, my dad said, you know, make sure you keep a 4.0 because once that GPA goes down, you'll never get it back up. And of course, I know, Kailey, you and David know that full well, and you kept yours up. But that's the same thing with consumers. That's the same thing with consumer sentiment. Very, very hard for an administration to turn it around once it starts to dip. And the problem for the administration here is they say, you know, just hold on, the pain will be worth it, and Congress is going to come in and save the day. Well, number one, I'm not sure they've been watching Congress the last few years, but coming in and saving the day by passing legislation is not Congress's strong suit. And number two, to Rick's point, now you've got these people going to these town halls and hearing from Republicans. You know, I was listening earlier, your great conversation with McKee, and David, you asked about the methodology of this survey, and I'm a social scientist. I love to talk about that. The problem for the president is even if you discount this, which they shouldn't, look at all the rest of the data. It is all coming in negative as far as Republicans' views of the economy under Donald Trump. And so that's the problem they face. Congressmen and women, senators are going to hear from their constituents. So unless they get this thing passed in Congress quick, which again is not Congress's strong suit, it's going to be a problem for them. So, you know, I would never say wait and see for Congress. They'll save the day. That's not a good thing these days.
I do want to mention for our audience here on Bloomberg TV and radio that there's currently a briefing underway by the White House Press Secretary Caroline Leavitt, who is talking about where we stand in these trade negotiations. She's citing progress, very good progress in her words, being made in tariff talks, though she also notes the retaliation we saw today from China, saying that Trump will punch back harder if the U.S. is punched, and that if China continues to retaliate, it won't be good for China, though she does reiterate, David, that Trump remains open and optimistic about a deal with Beijing. But again, no understanding yet that Beijing is picking up the phone.
Well, Rick, let's pick it up there. I'm curious what you think the administration still has in its quiver. So we've seen China show a distaste here in recent hours for continuing to ratchet this up. They say they've reached a ceiling. They're going to continue to fight this. But given what we've seen over the course of this week, those tariffs imposed by the U.S. going up to 145%, the pause that the president has put in place here. What's left in the toolbox here for this White House? Should there be concern among him and his advisors that they don't have a whole lot left here, much leverage left here as this goes forward?
Yeah, it's kind of interesting, because I think that what Donald Trump has shown is that he'll use all kinds of public policy mechanisms to try and create that leverage you're talking about, David, to get what he wants on the tariffs. Remember, when we first got introduced with tariffs only a few months ago, in this administration, it was all about fentanyl. I haven't heard the word fentanyl used in the last 30 days. And so we were going to be imposing these tariffs on our closest trading partners, Mexico and Canada, because they weren't doing enough to stem the flow of fentanyl and immigration. So that was a good example of Donald Trump dipping into the policy bag and finding things that he could use to try and leverage his negotiations. And that got everybody scratching their head saying, oh, well, then if we cure the fentanyl problem, the steel tariffs and the auto tariffs and the things that were applied go away. And now we find out, no, not at all. I mean, you actually don't need to have fentanyl to come across the border to have a tariff applied to you.
Yeah.
So I think that you're going to see more of that policy debate. You're going to see, all kinds of issues from national security to other economic issues filling up those voids.
Rick, thank you very much. That's Rick Davis, along with Jeannie Sheehan Zaino, joining us here, our Bloomberg Politics contributors here on Balance of Power on this Friday afternoon as we look ahead to the weekend and recess on Capitol Hill.
Very happy Friday to you, Charlie. Charlie has had a monster week this week, as we all have, trying to keep on top of the market action, which, of course, has been driven in large part by the policies emanating from here in Washington, and more specifically at the White House when it comes to tariffs. And so much attention, David Gura, has been put on the tariff policies of the president that some of the other news he's made this week has kind of gotten lost in the shuffle, including his announcement earlier this week that happening tomorrow are talks between the U.S. and Iran, those set to take place in Oman.
Yeah, Steve Witkoff, the president's envoy, continues to have a very busy travel schedule. He's in St. Petersburg, Russia today. That plane that he flies on is going to Muscat, Oman this weekend for those meetings that the U.S. is going to have with the foreign minister of Iran. Unclear sort of how they'll unfold, who will be there mediating those conversations, or if they'll be direct, but they certainly stand to be pivotal, perhaps. Chris Wright, the U.S. Energy Secretary, the 17th U.S. Energy Secretary, was on Bloomberg Surveillance this morning talking about the importance of that meeting for U.S. energy policy more broadly. Let's take a listen to what he had to say.
His agenda can be summarized as prosperity at home and peace abroad. Lower oil prices help both of those. And the peace abroad that's of most concern right now in the region where I am, in the Middle East, is Iran. During the Biden administration, oil prices were higher. There was sort of an appeasement attitude and no strong enforcement of sanctions, enormous funding to Hamas, to Hezbollah, to the Houthis, and a rapid advancement of their nuclear program. President Trump's agenda is exactly the opposite of that. It's peace through strength, but we simply cannot and will not accept a nuclear-armed Iran.
Well, when it comes to Iran, we saw even more sanctions on the regime yesterday. When it comes to these oil sanctions, the president has said he wants to go back to maximum pressure. Is that part of the conversation you're having with Gulf allies on this tour, that they'd be willing to step in if some of those Iranian barrels come off the market?
Well, fortunately, just from the United States production itself and the size of the global oil market today, absolutely we can tolerate squeezing out Iranian exports. And of course, do all the Gulf neighbors want the same thing we want? Yes. Do they fear a nuclear-armed Iran? Absolutely. Do they think now is the time to turn the screws and end Iran's nuclear weapons program? Absolutely. But yeah, can the world tolerate that? Absolutely. 10 years ago, 20 years ago, could this have happened? No. But today we both have large American oil production, better relations with our neighbors, and a strong, resolute leader. In 40 years of trouble, 45 years of trouble from Iran, we've never had a better chance to reduce Iranian power, reduce Iranian tyranny in the Middle East, and we don't want to miss that opportunity.
Mr. Secretary, the president has said a lot, even recently to me on Air Force One. He likes that oil prices are coming down. Do you and the president have a price in mind?
No, I think my whole life I've avoided predicting prices or dictating prices. You know, we have a wonderful free market economy. That's what makes the world wealthier. That's what allows consumers to continually re-express choices in every direction. So no, there's no formula for a good oil price.
Insightful conversation with the Energy Secretary Chris Wright earlier today on Surveillance with our colleague Anne-Marie Hordern as we consider the prospects of the talks happening tomorrow between the U.S. and Iran and what implications they may have for global energy markets. We turn to Ellen Wald, non-resident senior fellow with the Atlantic Council Global Energy Center and president of Transversal Consulting. Welcome back to Bloomberg TV and Radio. Ellen, when we consider the moment at which we're having the conversation, or the U.S. and Iran is entering these conversations in global oil markets, knowing OPEC Plus is suddenly putting more supply onto the market despite weakness in prices, what difference does the supply of Iranian crude, whether it is more constrained or potentially more available on the market, how does that impact the overall picture?
That's a really good question, and I think there are a couple key points here. And it's interesting that the U.S. Energy Secretary thinks that getting rid of all Iranian barrels from the market is something that the market could tolerate. I think he's probably right, but it's not going to be quite as easy as he thinks. There's definitely spare capacity available that could definitely make up for Iranian barrels if they choose to really squeeze on the sanctions. But I think you will find that China will get very, very upset by this because they really like their discounted Iranian oil. But given that President Trump seems to want to negotiate all things with China, I'm sure that this is also up for negotiation. Maybe if China agrees to buy less Iranian oil and really help squeeze Iran, President Trump's willing to make changes in the tariff regime there. So I wouldn't be surprised if it's all together, it's all lumped together, it's all up for negotiation. I do think that when you look at maybe a potential for more Iranian barrels to come on the market down the line, say after some kind of an agreement, that's something that the oil market and the global market's going to have to work out. It would be great if that happened in conjunction with an economic boom where demand is trending higher than opposed to right now where we're not really so sure.
Ellen, I was struck, I don't know if you were, by what we heard there from the Energy Secretary at the end of those comments. He says he doesn't have a price in mind and there's no formula for a good oil price. I'm surprised only because he was the CEO of Liberty Energy and has spent his whole career in the energy business. I would assume that he would have some sense of that. What do you make of that? As you look at WTI here at $61.44 a barrel and we see these prices drifting lower over the course of the week, this is bound or likely to pose some problems for producers here in this country. How do you identify a good price here for oil in this environment?
I think the Energy Secretary was giving the Ali Naimi answer, and everyone would ask him. He used to be the energy, for Saudi Arabia and the CEO of Aramco, and he would say, if I knew what oil prices would be, I'd be in Vegas, or there is no perfect oil price. So he was really channeling that. He definitely has an optimal oil price in mind. The question is it the optimal oil price for consumers or the optimal price for producers? And those are two very different things. And so right now, U.S. producers are not really liking oil prices right now. They'd rather see things higher, particularly because their costs are increasing. The cost to complete a well has just gone sky high with all of these tariffs on steel and in particular the tubular goods that they need to complete wells. And so, with prices trending lower, they're going to have to ask themselves, is it really worth it to complete this well here at current prices? And so those are some hard decisions that producers are going to have to make, and every producer has a different price point at which it makes sense. Smaller producers, they're going to be the first to shut in. Larger producers like Exxon, Chevron, they're going to be able to keep going for longer.
Well, so is what I'm hearing from you, Ellen, that this notion of unleashing American energy, drill, baby, drill, that's going to offset whatever cost pressures may arise, or at least a good deal of cost pressures that arise from higher tariffs on imports, that's not necessarily how this is realistically going to go down in terms of domestic production.
I would say that I see drill, baby, drill and, unleashing American energy as kind of more of a long-term strategy. Right now, we're at very high levels of production. We really don't actually need any more American oil coming into production right now. But, 10, 15, 20 years down the line, we're going to need that. And the things that we can put in place now and do now are going to make it possible for us to unleash American energy dominance in 20 years. So I think that they're not necessarily meant to coexist. The low oil prices, the trade wars right now, it's really causing some pain. What producers would really like now is some reassurance from the Trump administration that this is a temporary turbulence. It's going to be behind us soon, and they're going to be able to make decisions about how to deploy capital for the future as soon as this shakes out.
As soon as this shakes out, and you've taken us right where I want to go, which is how are producers, how are oil companies looking at the uncertainty we've been talking about? So kind of dovetailing this conversation about tariffs policy and this 90-day pause with your world with oil, I imagine it's having a chilling effect, as it is in many other sectors. What is the oil industry waiting for? What would amount to the kind of certainty they need here to proceed with capex expenditure, capital expenditure in the way that they were before?
That is a really good question. And I think what they need is some kind of roadmap for what the Trump administration is planning for the next 4 years when it comes to energy policy. What are the regulatory changes going to look like? What's the regulatory regime going to be? All we know is that some of the regulations from the Biden administration have been done away with, but we don't know what's coming in their place. They don't know, and they would like to know. And so the best thing that the Trump administration could do for the energy industry right now is to give them a roadmap. Here are the kind of permitting, things we're trying to do, we want to put in place. Here are the steps we're going to take to ensure that these changes that we're making can't be undone by a future administration. Yes, these trade issues are a big deal now, but we expect in a year or a year and a half, there's going to be a lot of American-made steel available for purchase. And here's what we're going to do to make that possible. And those kinds of things would really help the executives at these oil companies feel more secure about making decisions to deploy, capital, to say yes to that big project, to drill exploratory wells, because they will have this surety that they need that, yes, when they apply for that permit, they can expect to get it in 30 days, not a year, and not have it challenged by 10 different people.
Ellen, I'd like to ask you about something else that the president has floated and we haven't heard as much about, at least within the last week or so, which is this notion of using secondary tariffs, which isn't something that has previously existed in geoeconomics, on countries that buy oil and energy from Venezuela or Russia. He has threatened to do this depending on whether or not he extracts the behavioral changes he would like to see from Venezuela when it comes to cooperation with migrant issues that he thinks they are not currently cooperating with the administration on in Russia when it comes to ongoing conversations around ending the war in Ukraine. Is that threat real to you? What would secondary tariffs on that crude actually mean for the global market?
Yeah, that's a very complicated question because we know what secondary sanctions means. I think that the difference that we're looking at between a secondary tariff in whatever that looks like and a secondary sanction might be that sanctions are actually really hard to enforce. So really, the way that it works is that people get scared about sanctions being enforced, and so they adhere to them. To actually enforce a sanction requires a lot of effort and time, and you've got to make a really big case. You've got to assemble a lot of evidence, and only then can you find them and get the money, and it takes a long time. With tariffs, I think the idea is that it's much quicker. You're not going to have to go through an entire process and assemble all this evidence that, he can kind of say, all right, well, I'm putting this tariff on Spain because they're buying, this thing from Venezuela, and Venezuela is not, concurring with what we want in terms of their drug policy. And because he has a lot more leeway with how to deploy a tariff, it can be deployed much faster than, say, enforcing a sanction. But I'm kind of in the same boat as you guys. We're not exactly sure what this looks like because we've never really seen it employed before.
Ellen, great to get those insights from you. Thank you very much. That's Ellen Wald, non-resident senior fellow in the Global Energy Center at the Atlantic Council, also the president of Transversal Consulting. As we talk about the oil market again, we've seen WTI around $61 a barrel today over these last few days, that drift downward in oil prices. And just to keep an eye on all of the markets here as we kind of push to the weekend, enthusiasm evidently for the weekend as well after this very rough week. In the equities markets, we see the S&P 500 up 2.2%, the Dow and the S&P 500 and the NASDAQ all up on this afternoon. In the bond market, it has been a different story here today and over the course of the week.
Well, it certainly has. At one point, we were looking at the worst week potentially in terms of basis point move upward on the 10-year yield going back to 2019 when we were having some plumbing problems. But interesting to see, after reaching as high as 458, the 10-year yield right now back down at 446. We're only up about 4 basis points on the day. But of course, that is the market that not only we are paying close attention to, but we understand the president of the United States is as well, watching for any sign of queasiness or yippiness like he saw earlier this week.
Queasiness or yippiness. We'll continue to watch that as the afternoon goes on here on Bloomberg Television and Bloomberg Radio as we pay attention to the markets, politics, policy, the uncertainty that envelops Washington when it comes to trade policy. All of that continues here this afternoon.
Yep, and they'll continue that coverage on Bloomberg Business Week. I'll see you back here on Bloomberg TV and radio at 5 p.m. Eastern.